Okay, it is recording this time. I was talking and it wasn't recording. Um, so yeah, I was saying that I'm sorry that they had to cancel the class today, and I was actually in a conference to see what tools are available out there to help you guys to learn topics better, how to integrate AI, and tools like ChatGPT or Copilot and all those stuff into our courses, so I can help you with the topics much better. All right, so let's start the topic for today. We were talking about the foreign exchange market and uh, international relations of the countries with each other. And today we're going to talk about the ratio of or the rate at which we can exchange the currencies of different countries. So for that, we are looking at the foreign exchange market. We know that for everything in the economy, we can define a market and look at the demand side and supply side of those markets. And in the foreign exchange market, this market actually facilitates the conversion of currencies. For example, if I want to exchange my US dollar into Canadian dollar, there's a market that I can exchange it. There's a specific rate for that exchange, which is the price of those currencies. So we need different currencies to buy goods and services or invest in other countries. For example, if I want to travel to another country, let's say I want to travel to Turkey, I need to just exchange my US dollar into the Turkey's lira, Turkey's currency, and that happens based on a specific rate. Or if I want to invest in Canada, I need to exchange my US dollar into Canadian dollar. Or let's say if I want to buy some goods or some services in Mexico, I need to exchange US dollar to Mexican peso. And the rate at which we exchange those currencies in this market is the exchange rate. Okay, we will talk more about that because there are real and nominal exchange rates, and we're going to distinguish between those two. But first, let's see what the foreign exchange market is, and for that, we're going to start with just US dollar market. Okay, we're going to just simplify the world. We know that each country has their own currencies. Um, like Mexico has peso, Turkey has lira, European countries, each of them have their own currencies other than the euro that they are using in the euro area. So we can think of all of these in the foreign exchange market, but we're going to simplify it. And whatever that we learn in the market for the US dollar, it could be generalized to all other currencies as well. Okay, so let's look at just supply and demand of the US dollar. Um, give me a second to um. Here it is. So I need to open my notes, not to forget details. We're gonna be here. Okay. So earlier I asked you to think about who is the supply side of the US and who is the demand side of the US. And I hope that you have thought about it. And now I want to let you know who those people are, who those um, parties of the market are. US dollar suppliers are the Americans who are just buying the goods or services or investing in other countries. So the supply side are the Americans, okay, are the main suppliers, and the people who need to invest inside the US or buy the US goods and services, the foreigners are the demand side of the market. If you think of, um, let's say, this foreign exchange market, okay, a exchange market. For example, let's say you go to the bank or you go on a website to buy and exchange those currencies with each other. So that wherever that you are exchanging those currencies are known as the exchange market. Okay. So the foreigners go to that market. Okay. And let's just simplify it and assume that we are only facing two different countries or two different areas, let's say Europe and the US. So let's assume that there is only euro and dollar in this market. The foreigners from Euro area, they just supply euros, okay? And they need to invest in the US or they need to buy US dollars for any purposes that they need. Okay, so they go to the market, they supply euros. Okay, so they supply these euros and they exchange it with US dollars. On the other hand, we have US people, American people who are supplying these dollars, okay? And we have some people who demand euros in this market. So you see, we have both supply side and demand side in the market. Um, so if I want to summarize it, demand comes mostly, demand for any currency comes mostly from the foreigners and speculators. Okay? And the supply comes from citizens of a country for the most part, and some part of it comes from the speculators of those currencies. But why do these people need to exchange those currencies? Why this market exists, better say. So the supply side exists to buy goods and services from other countries, okay? And the demand exists first to buy goods and services from the US. Like people might want to buy iPhones for they want to go to Disneyland. All of these require the payments in um, dollars. Second, they want to invest in the US. For example, they want to buy a house in, say, Florida, or buy um, US stock or bonds. And the third reason for this demand to exist is to speculate and gain from changes in exchange rate. Earlier, we talked that there might be some reasons for the exchange rate to fluctuate. And when those exchange rates fluctuate, the traders, the currency traders, trade the currencies between countries to just gain um, some profit from that action. Okay. And then in this example that we were discussing, we only had the supply of dollars. Okay. So the supply of dollar was almost equal to the demand for euro because we assume that there are only European people and American people. Okay. We say that these are the same. All right. The same as if, for example, supply of dollar increases, the same amount of the demand for euro will increase. Okay, so let's look at it graphically. Let's say that we have market for market for dollar, okay, and we have market for euro. From now on, when we are talking about foreign exchange market, for example, in exam, if I ask you what is happening in the dollar market, euro market, you're gonna have both sides of the market together. For example, if I'm talking about dollar market, I'm gonna have at the same time supply and demand for dollar. Okay, so if this is the supply for dollar, this is the demand for dollar, this is the quantity of dollar available in the market, and this will be the price of dollar in that market. And at the same time, I expect you to draw the euro market as well. Okay, so we're gonna have supply of euro just next to demand for euro, the quantity of euro, and the price of euro. Okay. So when we are talking about the exchange market, foreign exchange market. For example, comparing the dollar and euro, we're going to have market for both of them next to each other. If I ask you any questions, what is happening in either of these economies, either of these currency markets, I expect you to draw the graph for both of them and explain the situation, explain what is happening in those markets together. Okay, this will be my expectation for this topic, because earlier I showed you that any change in one of these, okay, supply of dollar is just like the change in the demand for euro, because people of one country are providing their own currency because they need the currency of the other country. And the need is the demand side, and the providing that currency is the supply side. All right? So now let's see what the prices and the prices of dollar and prices of euro are. If we want to talk about the rate of exchange, the exchange rate between the dollar and euro, okay, when we are talking about dollar and euro, those two currencies together, the price of dollar will be in terms of euro, and the price of euro will be in terms of dollar. Okay? For example, if I say that here is the equilibrium, and let's say the equilibrium is $1, okay? This $1 will be equal to, say, 2 euros per dollar. Okay, so this currency over here will have the unit of euro per dollar. Okay, the same for the euro, but the price will be in reverse. For example, if this is 1 euro, then this will be, say, 0.50 dollars per euro. Okay, you see what I mean? So when we are talking about price of euro, that should be in terms of dollar. When we are talking about price of dollar, that should be in terms of euro. So do not confuse these. So when I'm asking any questions that requires drawing a graph, I would expect you to just write these properly. If you are in the euro market, it should be dollar per euro. If you are in the dollar market, it should be euro per dollar. Okay? Just like if you think of the market for goods, so if this is the goods and services market, you have the quantity of the goods, you have the price of the good, you have supply and demand for the goods. Okay, and let's say you say that 1 pound or um, 1 pound of tomatoes, let's say, is $2. Okay, you say that each pound, 1 pound, is $2 per pound. Right? So the price in here for the goods is in terms of dollars. And here, the price of the dollar should be in terms of another currency that we want to exchange it with. Okay? All right. Now let's look at different types of the exchange rates. As I said earlier, we have nominal exchange rate and a real exchange rate. So whatever that you see in the market, that is the nominal exchange rate. We are living in the nominal world. Okay. So when we are talking about the wages, when we are talking about the prices, not the prices, I mean the income or exchange rate on the news, exchange rate on Google, all of those are nominal exchange rate. You go to Fred website and check the income per capita. That is the nominal exchange rate, unless it is mentioned clearly that it has turned into a real. Okay, so we are learning what the nominal exchange rate is and what's the difference of that with the real exchange rate. Nominal exchange rate is the rate at which a person can trade the currency of one country for the currency of the other one. If I go to this market, okay, if I go to the market, exchange market, and let's say I need to buy euro, I provide, as a US citizen, I provide US dollars into this market. The supply of dollar in this market will increase because I want to buy euros, and the demand for euro will also increase. Okay. And the rate that I exchange that is the nominal exchange rate. We express all exchange rates as foreign currency per unit of domestic currency, just like what I showed you here. If I want to know the price of dollar, I say euros per dollar. If I want to know the price of euro, I say dollar per euro. Okay, that's exactly what I'm saying here. Each currency, each exchange rate is expressed as foreign currency per unit of domestic currency. Foreign currency per unit of domestic currency. This is market for euro, so the foreign currency for them will be dollar, their domestic currency will be euro. Okay? For example, if you look at the exchange rate, some exchange rate in 2024, in September 2024, for $1 was almost equal to 1.35 Canadian dollar per unit, 89 cents per dollar, or 143.91 Japanese yen per dollar, or 19.41 Mexican pesos per dollar. If you want to update these numbers, okay, I would suggest you either Google that, or there's this website xe.com that you can simply just select the currencies that you want to exchange. For example, I want to know how many euros I need, how many, let's say, okay, so US dollar. Okay, how much is one US dollar in terms of, say, lira, Turkish lira? They just convert it, and that will give you $31 is equal to 37.97 Turkish lira. Okay, it means that 37.97 Turkish lira per dollar. Okay, we will express that in foreign currency per unit of domestic currency. For example, if I want to say what is one Japanese yen in US dollar, let's check that. So I'm going to find Japanese yen. Here it is in US dollar. Okay, just type in the names of the countries, and it will give you Japanese yen in US dollar, which is 0.0069 uh, dollars per yen. Does that make sense? So the answer for this will be 0.0069 dollars per Japanese yen. The question is asking one Japanese yen in terms of dollars. So I need to look at the equal amount of dollar per Japanese yen, 1 unit of the domestic currency. Here in this question, 1 unit of domestic currency is the Japanese yen, and I need to find the equivalent amount in US dollars. Okay, or I can just simply hit this line in the middle, and you can see the reverse of it. It is 143.45 Japanese yen, 143.45 Japanese yen per dollar. These are exactly same numbers, okay? Both of these are the nominal exchange rate that we can use to convert Japanese dollar and Japanese yen and dollar. If I want to exchange some dollar and go and travel to Japan, I can just exchange my dollar with these ratios. Okay. What if those ratios, this rate increases or decreases? Earlier, we talked about strengthening and weakening of a currency. We talked about what a strong dollar means, what weak dollar means. That is just some language that we use in daily life, like in informal way. If I want to talk about it in economic language, instead of saying strong dollar, we say appreciation. If I want to say weak dollar, it means that the value of dollar have decreased, and we call it as depreciation. We use this appreciation and depreciation in any of the currencies. Appreciation or strengthening of the currencies, it means that there is an increase in the value of a currency. For example, if euro have appreciated, it means that euro has an increase in the value of a currency. It's a measurement as measured by the amount of the foreign currency that it can buy. Okay, if that amount has increased, that is the appreciation, strengthened currency. But depreciation means that there is a drop in the value of a currency. For example, if euro has depreciated, it means that there is a decrease in the value of a currency as measured by the amount of foreign currency it can buy. Okay, how many units of dollar it can buy. For example, exchange rate rises from 80 to 90 yen per dollar. The dollar is set to appreciate. A Japanese yen now buys less of the US currency. The yen is set to depreciate. Okay, if exchange rate falls from 80 to 70 yen per dollar, the dollar is said to depreciate. Okay, and on the other side, the yen is said to appreciate it. All right, so two currencies are changing in reverse. If we see that, um, let's say exchange rate um rises from 80 to 90 yen per dollar, this is appreciation. Yep, appreciation of dollar. We say that dollar has appreciated, and on the other side, depreciation of yen. Okay, so the meaning of this fluctuations, this change from 80 to 90 means that dollar appreciated, yen depreciated. Okay, all right. So dollar appreciation, as I said, is same has the same meaning as the stronger dollar. They mean the same thing, but are used in slightly different contexts. Dollar appreciation is more technical. We economists use it in economics terms. And this means the value of the dollar, the value, for example, US dollar, has increased relative to another currency or a basket of currencies. For example, if one US dollar used to buy 100 Japanese yen and now it buys 110 yen, the dollar has appreciated against the yen. Okay? This is how we say in economics terms in technical form in our classroom when we are discussing, we're going to use this language. Okay, but in media, but in or in policy discussions, you might also hear stronger dollar. Okay, not only you might hear appreciation of dollar, you might also hear strong dollar, but it is rarely used in the technical form or economics terms. This is more of informal way of saying the same thing, that the dollar has appreciated. It often shows up in headlines or everyday language, like the dollar is getting stronger. It can now buy more foreign goods and or foreign currency than before. Both of them has the same meanings. The same, um, we can say the same information about the depreciation and getting weaker. Okay, so depreciation and weaker dollar has the same meaning. Okay, so this has just 1p. Sorry, depreciation. Yes, with 1p, not 2p's, and um weaker. Okay. Uh, Earlier we discussed that nominal exchange rate is the rate at which we can exchange the currencies of one country for the other, for the currency of the other country. For example, we had the 1 US dollar in 2024 was equal to 1.35 Canadian dollar. Okay. Um, or we can say 1.35 Canadian dollar per US dollar is equal to 1 Canadian dollar X US dollar. And I can find this X value being equal to point 74 US dollars. So 1 Canadian dollar is equal to 0.74 US dollar. Okay, so if I know this ratio, I can just change it. I can exchange that value either in terms of Canadian dollar or US dollar or any other currency that I need to find out. Or let's say $1 is equal to 89.89 euros, 89 cents. And I can again do the same thing. 89 euros is $1. I can rearrange it and find the value of €1 in dollar. Okay, finding the x is gonna give me 1.89, 1 over 0.89, which is I think $1.12. So €1 is equal to $1.12. All right, but it's not um, remaining the same all the time. Okay, let's say we might have um, let's say $1 might be equal to, so let me write it in this slide because I want to show you what appreciation and depreciation means. Then I am gonna move to more um, to a graphical form of the example. Okay, so let's say $1 is equal to 19 Mexican peso. Okay, this, let's say in 2023 was this much, but in 2024, let's say it turns to this rate. Let's say just some imaginary numbers. Mexican peso, 15 Mexican peso. Let's say it changed from this ratio to this one. Okay. And it means that between 23 and 24, dollar had depreciated against peso, and peso has appreciated against US dollar. Okay. Or you can look at similar scenario in on the market between euro and dollar. So $1 is equal to 0.88 euros. And later it turns into $1 being equal to 0.90 euros. Okay, this means that over this time period, going from 0.88 euros to 90 euros, we have dollar being appreciated because we can buy more euros with the same $1. So dollar appreciated against euro, and euro depreciated against dollar. So you see, we do not have uh, the same rate all the time. The nominal exchange rate is always fluctuating. Okay, we see fluctuations in price of currencies. It is all the time changing. So now let's see those fluctuations, okay? Those fluctuations in the currency market in the form of, let's say, in the graphical form, okay? So we have a this market for dollar and market for euro. All right? So we have supply for dollar, demand for dollar, price of dollar. So it's going to be in terms of euro per dollar, right? And we have quantity of the dollar, how much dollar is available in the market. Just like any other market, we have this equilibrium point. We also have market for euro. So we have supply of euro, demand for euro, quantity of euro, price of euro here. This is going to be dollar per euro. The unit is dollar per euro, and we have the equilibrium point in this market. Okay. So changes in the nominal exchange rate, we learned that are called as appreciation and depreciation. If $1 buys more foreign currency, that is the appreciation of dollar, strengthening of the dollar. $1 buys less foreign currency, for example, less euro in this example, it is called the depreciation of dollar or weakening of the dollar. Okay, and now let's say that exchange rate rises from 80, 80 to 90 yen or 90 euros per dollar. Okay, let's say we just experience some kind of increased demand. We're going to talk about possible um, reasons and factors that could cause this, but we see that demand, let's say, demand for dollar shifts to the right, and we're going to have new equilibrium point. Earlier, we had, let's say, 0.88 euros per dollar. Now, let's say we have point 90 dollars per euro. You see, this means that dollar has appreciated. And we learned earlier that an increase in the demand for currency means an increase in the supply of the other currency, right? So we have supply of euro. The European people are demanding dollars, so that increases the dollar demand. And at the same time, because they are buying dollars, they are providing more euro into the market. So it will shift the euro dollar to the right. Now, if you look at this new equilibrium point, comparing these two values, you see exactly what I just said earlier. Euro depreciated 1.11, 1.13. This is the euro market, and this is the dollar market. Right. And here you see that euro depreciated. Right. Let's look um, the reverse of these. Let's say this time demand for dollar, instead of increasing, let's say this time it decreases. If this is the demand for dollar, I would suggest you to pause the video and try to just do the same thing in here in these two graphs, but this time, instead of change in the demand for dollar, this time let's say the demand for dollar, instead of going to the right, this time it will go to the left and it will be decreased. And try to see if you can write all of these points, all of these names correctly. Okay, so I'm writing this and pause and then watch and see if you have correctly just named and labeled everything. So we have demand for dollar, supply for dollar, quantity of dollar, price of dollar, which should be in terms of euro per dollar. Okay. We have equilibrium point. Let's say it is 0.88, just the previous one. Could be any number, so I'm not writing this here. You can find it online for the most recent amounts. And we have market for euro. We have supply of euro, demand for euro, supply of euro, price of euro, which is going to be dollar per euro. And this is the quantity of euro. And this is the equilibrium price of euro. This time, let's say something happens and a shift in the demand curve, and the dollar market shifts the demand to the left. We're gonna have this new demand curve, new equilibrium point, which says that dollar depreciates. Okay, so when we have dollar decreasing, the value of dollar decreases, this axis over here shows the value of dollar. If the value of dollar decreases, it means that the dollar has depreciated. And that is equivalent to the change in the supply of euro. Supply side of the euro also goes to the left if Europeans are buying less dollars, so they keep or they hold on to their own euros. So the new equilibrium point here will cause the euro to appreciate. Okay, so I'm gonna ask you a question. Think about this. Okay, is depreciation good or bad for a country? We're going to discuss about this. We earlier learned that um, the answer for this question depends on the change in the net export. If net export increases, it could be good. And if net export decreases, it could be bad. What do you think? Think about it. All right, we're going to talk more about that um, later in this session or on Monday. So, appreciation is the exchange rate, okay? Appreciation of the uh, ex- exchange rate or depreciation of exchange rate. Let's look at some examples. Appreciation means an increase in the value of the currency, and depreciation means decrease in the value of the currency. So now let's look at an example. Okay? So what is the exchange rate in each of these scenarios? Did the US dollar appreciated or depreciated? Pause the video and think about it. Think about each of these parts, part A separately, then part B separately, and solve the question and see what is the exchange rate in each of these scenarios separate from each other, and then see if the US dollar has appreciated or depreciated. Okay, so pause the video and think about it. Right, I'm assuming that you did pause the recording and you solved it. So let's go over the solution. Last year's exchange rate in part A was equal to 100 yen per dollar. And this year's exchange rate is equal to 105 yen per dollar. So you see that US dollar has appreciated. $1 now can buy more yens than last year. So yen depreciates. Both of them, the direction of the changes in yen and dollar are in reverse. One of them appreciates, the other one depreciates. The same in part B. The last year's exchange rate was 25 pesos per dollar, and this year's exchange rate is 20 pesos per dollar. So US dollar has depreciated against peso. $1 now can buy fewer pesos than last year. So you see, in some scenario, both of them are happening this year and last year, and it depends in which currency value are you measuring the value of dollar. Okay, depending on the value of the dollar, you can just determine if the dollar has appreciated or depreciated. All right, it could be appreciated against one currency while it has depreciated against another currency. Okay, so and note that, let me write this down. Note that we're assuming prices across these countries, like in Japan or in Mexico, does not change. We're going to discuss about that later, why I'm assuming that the prices does not change here, because if it changes, it will affect on the results. Okay, we are assuming that the prices are not changing, so based on this, is appreciation, it is depreciation, good or bad. So depreciation of dollar means that depreciation of dollar means that US goods are cheaper. We earlier discussed about this for foreigners. So we're going to experience an increase in the exports, and foreign goods will be more expensive for US citizens. So we will see import being decreased. And we know that net export is equal to export minus import. If this is increasing, this is decreasing. So in total, we will see an increase in the in the net export. So assuming that the prices does not change, everything else is the same. So depreciation benefits the country because we know that net export is part of the GDP, and any change in the GDP, any increase in the GDP is resulting in the um, growth of a country, right? In the long term, it could just mean as the growth of the country. Now let's look at the factors that could shift the supply and demand in the foreign exchange market. There are different factors like income, interest rate, expected future currency. We talked a little bit about these earlier, okay? Now let's make it a little more rigorous, seeing that in the form of um, graphs. Okay, let's look at it graphically. All right. Okay, if we have more income, okay, if the income in the US increases, it means that we can buy more goods. Let me just use these abbreviation, more goods and services produced produced in, let's say, let's this time discuss about um Mexican peso and US dollar. Okay, so here let's think about Mexican peso and US dollar. Um, in the previous example, we were looking at euros and dollars. Here, let's look at Mexican peso and US dollar. So you will see that we can just generalize all those topics in different contexts, different currencies. Now, if the income in the US increases, we're gonna buy more goods and services produced in Mexico. What it means that US citizens are going to demand more peso. So demand for peso is going to increase. Let's show this story on the graph. Okay, so we have supply and demand. Let me just copy this here. Uh, we have dollar market and we have peso market. Okay, and we have supply for dollar, demand for dollar. I would again suggest you to pause the video and try to label these two markets, supply and demand and everything, and then come back and see if you label them correctly, and then I will continue, okay? So we have price of dollar, quantity of dollar, price of peso, quantity of peso, demand for peso, supply for peso. This will be in terms of dollar per peso, and this will be in terms of peso per dollar. Okay, so we have equilibrium point in both of these markets. Now let's work with some numbers. Let's say in the dollar market we have 19 pesos per dollar. Okay, and we have 1/19 peso per dollar. Okay, now let's just have this story, this change of income in the market, and let's see what's happening in the market. So I'm trying to show you the shifts in the exchange market. There are different factors that I'm going to go over some examples of those. And the first example that I'm talking about is the change in the income. And the example that I started with is the increase in the income of US citizens. If US citizens' income increases, people are gonna, let's say, are gonna travel to Mexico, are going to buy more goods from Mexico. In this simple example, I'm assuming that there are only two countries, Mexico and the US. Okay, that's why we can think of different countries as well, but for simplicity, I'm just looking at these two countries. So the US citizens have more income right now, so they're gonna demand more peso. The demand curve for peso is gonna shift to the right. We're gonna have an equilibrium which is higher than the previous one. And at the same time, when demand for peso is increasing, US citizens are buying peso in the exchange market, right? So, sorry. So we have more dollar supplied in the market, and the supply shifts to the right in the dollar market. Let's say this is 17 peso per dollar. So this will be 1/17. So see what happens when income of the US citizens increased, dollar depreciated and peso appreciated. So you see what happens? These are Americans. These are Mexicans. Okay, and these are Americans. These are Mexicans. Okay, the demand side is from another country. When we are talking about dollar, the supply side of dollar is Americans. So when they are buying more of the pesos, their supply of dollar in the market will increase and will shift the supply to the right and shift in the supply curve. We will see the new equilibrium point in each of these markets to be different in a way that dollar depreciated and peso appreciated. Okay, let's look at another example. Let's say this time income in Mexico increases, okay? And we want to see what happens to the price of dollar and the price of peso. Are they appreciating or depreciating? We want to just check this. If Mexican people have more income, it could mean that they're gonna travel to the US for the vacation. Okay. And if more Mexicans travel to the US for the vacation, we're gonna see these changes in these markets. Let's say we have supply, okay, and demand. I would suggest again pausing the video and trying to um, label these graphs by yourselves. Let's say this is market for dollar, and this is the peso dollar market. This is demand for dollars, supply for dollar. These labelings will have some will be part of the rubrics and grading rubrics on the exam. So make sure to practice as much as you can so you can learn them, okay? Demand for peso, quantity for peso, price of peso, price of dollar, quantity of dollar. I would expect you to know this peso is dollar per peso, and this is peso per dollar. Okay, I would expect you to write these as well. Okay, not just price of peso, price of dollar. I want to see this. I want to make sure that you understand both of these. Okay, so we have supply and demand. Now we have more Mexicans traveling to the US. It means that more Mexican people are going to buy US dollars. This is the Americans, and this is Mexicans. This is Americans. This is Mexicans. All right. Now Mexicans are traveling to the US, so they're going to demand more dollars. Demand for dollar is going to shift to the right while they are exchanging their own pesos with these dollars. So we have supply of peso shift to the right as well. Now compare the price in the new equilibrium and the previous equilibrium. So what happens? We see that dollar has appreciated, let's say from 19 pesos per dollar to 20 pesos per dollar. So this goes from 1 over 19 to 1 over 20, and it depreciates. So in summary, income in Mexico increases. Let's say GDP in Mexico increases. You know that at the country level, the income is equivalent to the total GDP of that country. And we will see that price of dollar, the value of dollar have increased. It is an appreciation, and the price of peso have decreased, which is called as depreciation or weaker peso. All right. Now let's look at the second factor. We had three factors over here, right? What I just showed you is the income effect. Now let's look at the effect of interest rate. These two were just showing you how the changes in the income of one country could affect on the currencies of those countries. This time, let's look at the interest rate. What if, for example, interest rate in Germany increases? I'm going to use colors over here, so pay attention to colors to see steps in this slide. This is important, and we're going to have several of these examples on Monday. Okay, let's say the interest rate in Germany increases. It means that Germans are going to um, Germany is going to be more attractive for the people across the globe. Let's, for simplicity, again assume that there are only two countries. Let's say US and Germany. Okay, and let's say that um, interest rate in Germany increases. It makes Germany as a good destination for the investors, an attractive place for investors. Okay, now let's see that on the graph. Here we have a market for dollar. We can draw so we have dollar market, and we have, we can either use mark, I think Germany's currency is mark, but let me just use euro. Okay, let's say that people are exchanging dollar and euro in this example. So we have quantity of dollar, price of dollar is going to be euro per dollar. We have supply of dollar, demand for dollar, equilibrium point, quantity of euro, price of euro is going to be dollar per euro, supply of euro, demand for euro. All right. So let's see what will happen here. So in the step one, right? Step one, let's say first label who is supplier and who is the demand side. Who demands let me just fit this. Oops. And let me just fit this in one line. Who demands each currency. Okay, try to fit this in one line. Um, I currency. Okay, let's go back to the graph and label. So the step one is to say, okay, these are Americans and these are German people. Okay, these are Germans. Second step is to see who is affected. Earlier, we discussed about each of these steps. If you remember, when we were talking about supply and demand earlier this semester, we were saying that, okay, when an event happens, the first step is to figure out whether supply changes, demand changes, both of them changes. Here, we are following the same steps. Okay, we want to see which of these graphs. This time, we're looking at two markets at the same time. We are looking at supply of dollars, supply of euro, demand for dollar, or demand for euro. We need to just check which of these are changing. So earlier here, we learned that when income in one country increases, it will affect on the citizens of that country only. But when interest rate is changing, that could actually affect on the uh, both countries, the citizens of both countries. So both Americans and Germans will be affected. So let's go over them one by one. When the interest rate in Germany increases, at first, we will see more Americans being interested in investing in Germany. And when they want to invest in Germany, they are going to provide more dollars into the market, shifting the dollar curve to the right. Okay, so but maybe it's better to say this way. So in the second step, when the interest rate in one country changes, both countries' citizens will be affected. So we will see that Americans and Germans want to invest there. And this investment, okay, both Americans and Germans, is going to affect on all of these curves. All right. So the third step, now that I know all of the curves are changing, now I need to think about it, the direction of the change. What direction and finally, what is the change in price of currencies? We need to figure that out based on the curves. So in the first step, we just labeled these people. Then in the second step, I know the figures that are going to be affected. And because it is the interest rate in one country, the citizens of both countries are interested in investing in a country that they can earn more, they can have higher returns. So both supply and demand on both markets will be affected. For example, let's start with the Americans. In the third step, we want to find out the direction of change. Let's start with the decision of Americans. Americans are going to demand more euros because they want to invest in Europe, in Germany, and to buy those euros, this demand for euro is gonna shift to the right. And at the same time, these Americans are providing dollars in the market. So the dollar will shift to the right as well. On the other hand, we also have the Germans or who used to be investing in some other countries. Now that their own country has higher interest rates, they are going to go back to their own country, right? So this time, the Germans are going to reduce the supply of euro in the market because they are going back to their own countries. They just collect the euros in the market and they're going to demand less of dollars. Now we have these two new equilibrium points. Okay, so the supply shifted in this direction, and the demand also shifted, demand of dollar shifted in this direction. Okay, and finally, let's see what happens to the prices. Okay, now we want to compare the price of each currency. We see that dollar depreciated as a result of an increase in the interest rate of the other country, okay? And the euro appreciated. All right? So the second factor that we just discussed was the effect of interest rate. If the interest rate in one country increases, in that country we will see an appreciation of their currency, and we will see the depreciation of the currency of the other market, which has lower interest rate. Okay? And the third factor is very similar to these. If people are expecting that in the future the currency of some country is going to be expensive or is going to be cheaper, their expectations can shift the supply and demand to the right and left depending on the situation. This is very similar to the examples that we had at the beginning of the semester. Okay, and you can draw it just the same as what we did for the income over here and the interest rate over here. Okay, now let's look at the real exchange rate. What we've been talking about so far was the nominal exchange rate. Now we want to see what the real exchange rate is. Nominal exchange rate was the rate at which a person just can trade each currency with the other one. But real exchange rate is the rate at which a person can trade the goods and services. Okay, so real exchange rate is in terms of the number of the goods and services of one country for the goods and service of another country. Real exchange rate is equal to nominal exchange rate times the price of the domestic level of the prices, domestic prices, and the level of the prices in the foreign country. Okay, we learned how to calculate the level of the prices using CPI or different price indices, CPI, PPI, GDP deflator. We can use any of those. And to calculate the real exchange rate, we need to multiply the nominal exchange rate with the ratio of the prices, level of the prices in two countries. Okay. If the exchange rate, or real exchange rate, if real exchange rate is greater than 1, it means that domestic goods are more expensive relative to foreign goods. It takes more foreign goods by one domestic good. And if real exchange rate is less than 1, it means that domestic goods are cheaper compared to foreign goods. Domestic goods are relatively more competitive. More competitive in international market. Okay. Let's look at an example. Let's say, so this example shows that um, in this example, I want to show you how their real exchange rate is determined, what the real exchange rate is. And now let's calculate the real exchange rate. A Big Mac costs $4 in the US, 380 yen in Japan. The exchange rate is 110 yen per dollar. It means that if I want to go to Japan and I want to exchange $1, I can get 110 yens for each dollar that I'm providing, that I'm supplying into the exchange market. The question is asking for computing the real exchange rate. Simply, you just need to plug in the numbers in this formula over here to calculate the real exchange rate. We know the nominal exchange rate, multiply it with the level of the prices. We are assuming that if there's only Big Mac, just in this example, I'm assuming that there is only one good in this economy, and that's only Big Mac. Okay, it could be, we learned earlier that the level of the prices could be calculated with the basket of the goods. But now we are just assuming that there is only one good in that basket, and that's only the Big Mac. That's why we calculate the cost of that basket. And cost of that basket is $4 in US dollars and 380 yen in Japan. So I need to multiply this 110 nominal exchange rate times the level of the prices, okay? 110 times 4, and then divide it by the prices in the foreign country. Foreign country in this example is Japan, because we want to calculate the real exchange rate. Okay, and it means that to buy, if I just calculate all that information, 110 times 4 divided by 380, this is equal to 1.16. Just plug in the numbers in the formula. Okay, E times P domestic over P foreign. Okay, this formula. This means that to buy a Big Mac in the US, a Japanese citizen must sacrifice an amount of money that could purchase 1.16 Big Mac in Japan. Okay, so sometimes some people say that a Japanese citizen, it is not the correct way to put it. It is not the a technical term, but just to simplify it, we can say a Japanese citizen can exchange 1.16 of a Japanese burger for an American one, which they uh, if they want to just exchange it into dollars, that's basically the same thing. Okay, so it's just non-technical term. If I want to say a Japanese citizen can exchange 1.16 of a Japanese burger for an American one, so what we say is to buy a Big Mac in the US, a Japanese citizen must sacrifice must sacrifice sentence. Buy a Big Mac in the US, a Japanese citizen must sacrifice an amount that could purchase 1.16 Big Mac in Japan. Okay, let's look at another example. The exchange rate is 20 pesos per dollar this time. The price of a tall Starbucks latte is $3 in the US and 40 pesos in Mexico. What is the price of a US latte measured in pesos? I would suggest you to pause the video and see if you can solve the question by yourselves. Okay, I assume that you paused the video. So I'm going to go over part A and part B in the next slide. If you haven't paused, I would suggest you to pause and try to solve it by yourselves and finding the price of US latte measured in pesos, okay? And calculate the real exchange rate measured as Mexican lattes per US latte. All right. So, what we know so far from the question is the nominal exchange rate, the price of latte in US, and the price of latte in pesos in Mexico. The question is asking first, what is the price of US latte measured in pesos? If I want to find the price of latte in pesos, I need to multiply that price with the nominal exchange rate. Okay, so the nominal exchange rate, 20 pesos per dollar, times $3 per US latte. So if I want to calculate this in terms of pesos, I just need to convert this number using the nominal exchange rate. All right. So the 60 pesos per US latte says that each latte in the US is $3. That same latte in Mexican peso is worth $60. Okay. This is different than what you see in the what is happening actually in Mexico. Okay, so let's calculate the real exchange rate. Does this mean that it is expensive? The latte is expensive in the US, or am I a richer in Mexico, or what? So it is something that I need to use real exchange rate to understand it, whether I'm richer in Mexico or richer in the US. So for that, to calculate the real exchange rate, just plug in the numbers. Nominal exchange rate 20 times $3 per US latte divided by 40 pesos per Mexican latte. Okay, and it will be 60 from here over 40, and that will be 1.5 Mexican latte per US latte. So I can exchange, in non-technical terms, I can exchange one US latte with 1.5 Mexican latte. See? So the real exchange rate is in terms of the goods and services. Nominal exchange rate is in terms of the currencies. So do not confuse these two. And to compare the real value of our money, we can use the real exchange rate. Okay? So the nominal exchange rate, whatever that you see on the news, on the website, on the Google, that is this number over here, the nominal exchange rate, the rate at which you are exchanging the um, dollar and other currencies. But the real exchange rate is nominal exchange rate times the ratio of the level of the prices in those two countries. Price of a domestic basket of goods relative to price of a foreign basket of goods. In the previous examples, we assumed that those baskets are only including Big Mac or only including Starbucks latte, but in reality, these are actually the CPIs that we were calculating. So the US price level, CPI in the price level, consumer price index, measures the price of a basket of goods, and we show it with P. Sometimes in some textbooks, you might also see E times price D, price of F. Okay, this is just naming stuff, but that's basically the same thing. They use um, the D for price of domestic price level of the domestic goods and PF for the foreign price levels. Basically the same thing. If US real exchange rate appreciates, it means that US goods become more expensive relative to foreign goods. See, we say relative to the goods. Goods change relative to the goods. We do not say US dollar becomes expensive or becomes cheaper relative to the foreign currency. Okay, we're not talking about the currencies. The real exchange rate is comparing the goods together. But what does that mean? Okay. It actually provides, we can actually use it to understand the purchasing power of our money. Purchasing power refers to the value of money in terms of the goods it can buy. What is the purchasing power of $1? I can buy with $1 um, an apple in the US if I exchange exchange that $1 into pesos, I can buy the same apple with the same quality in Mexico as well, or in Europe as well, or in Japan as well, the same apple with the same quality and same quantity. This is called as purchasing power parity. Okay, it means that having the same exact basket quantity and quality wise as best as we can. Okay, we buy the same basket in the US and in Mexico. If we just buy this basket in Mexico, let's say for 2,000 pesos, okay, let's say, give me a second. Um, all right, so for example, if I buy this in Mexico for 2,000 pesos, okay, and take this basket to the US and sell it at $100. This is the same as $100 at the market, that we can just exchange that $200 with $100. You see what I mean? So the rate of nominal exchange rate in this example is 20 pesos per dollar. And our dollar has the same value in both countries. If I want to buy this basket in the US, it's gonna worth $100. If I buy the same basket in Mexico, that is gonna be exactly the same $100, but in terms of pesos. This is what the purchasing power parity says. Purchasing power parity is a theory that says that $1 in the US has the equivalent buying power or has the equivalent purchasing power as PPP conversion rate, as purchasing power parity conversion rate. In this example, purchasing power parity conversion rate is 2,000 pesos over 100 US dollar, which is exactly equal to 20 pesos per US dollar, which is exactly equal to the nominal exchange rate. But PPP does not hold all the time. What if you buy the basket in Mexico for this, let's say this time instead of these numbers, let's say you buy the basket in Mexico for 116, 100 and sorry, 1,600 pesos, the same basket. Okay, you buy this for 1,600 pesos, and then take it to the US and sell it at $100, then convert it, convert to peso, and you will have 2,000 pesos. What happened here? So, basket in the US, okay, and so initially you bought this basket for 1,600 pesos in Mexico, took it to the US, sold it at $100, and you know that nominal exchange rate is the nominal exchange rate is 20 peso per dollar. Because of that, what happened? Exchanging this $100 to pesos is giving you some profit. See, you buy cheap, sell it, and because of this exchange rate, nominal exchange rate, you can exchange that to higher amount of pesos. But PPP says that this nominal exchange rate and this PPP rate, the ratio of the price of the same basket, should be exactly equal. If they are not equal, they must converge. And that happens due to arbitrage. Let's see what arbitrage is. So let me show that graphically. Okay. Okay. So we have, where is it? Okay, I want to keep this. So purchasing power parity says the nominal exchange rate and purchasing power parity conversion rate should converge due to arbitrage. Or what arbitrage is? Let's say we have market for the basket and market for the currencies. Let's draw the graph for each of them separately. Let's say we have a market in Mexico and market in the US. So we have Mexico on this side and we have the US on this side. We have market for the goods here, supply, demand for that basket, and this is the price of the basket or CPI. And we have the same CPI in the US, quantities, we have supply and demand in the US. Okay, and we have this initial equilibrium in each of these countries. Let's have the currency market. This is the quantity of peso. This is the price of peso, dollar per peso. We have supply and demand for peso. And we have quantity of dollar, peso per dollar. We have supply of dollar, demand for dollar, equilibrium points. Okay, so we have these equilibrium points. Now let's say in the example we had the price in Mexico was $1,600, 1,600 pesos for the same basket. You bought the basket at 1,600 pesos and took it to the US, sold it for $100. What arbitrage says that when people find out that this is happening, they can gain some benefit, some profit from buying at the cheaper place, selling at the expensive place, and they can gain profit from that action. They will do that several times. They will just buy the goods here, take it to the US, going back again, buying more goods, selling in the US, buying more goods, selling in the US. And this will be something like this. The supply of goods in Mexico will decrease, okay? And the supply of the same good, the same basket in the US will increase. We will see that this shifts to the right, this shifts in Mexico to the left. Now compare these new equilibrium points. See, this is increasing the price level, and here the price level drops down. This is the market for the basket, okay? Let's look at how it relates to the market for currencies. How it is determining the market for currencies. So when these people are buying the goods in Mexico, selling it in the US, it's exactly the same as supplying more dollars. Okay, this time we take the dollars into the market, the dollar in the market increases, supply of dollar increases, and the demand for peso is increasing. People are going to buy the goods here in Mexico. People want to buy in cheaper place, so they want more of currency of that country. So the demand here is going to increase. Demand for peso is going to increase, and the supply for dollar is going to increase as well. We're going to see a shift to the right in both of them. Now compare the new equilibrium point. What do you see? Here we see that peso appreciated and this one depreciates. Look what happened. Just look what happened. When you compare these two together in the market for the basket, the price of basket in pesos increased. The price of basket in US dollar decreased. Comparing these two together, this ratio means that price in the foreign country to price in the domestic country is increasing, right? This is increasing. On the other side, in the currency side, peso or US dollar. Okay, what is happening to peso US dollar? It is depreciating. It is decreasing. This is exactly what purchasing power parity says. Purchasing power parity says that this value, this level of the prices, the ratio of the level of the prices should get closer to this nominal exchange rate. This is equal to nominal exchange rate, which is decreasing. Earlier, we had this nominal exchange rate, 20 pesos per dollar, was larger. So, because of arbitrage, it decreased. On the other hand, level of the prices were smaller. Again, because of the arbitrage, it is increasing. And purchasing power parity says these two rates should converge. And that happens because of the arbitrage. In the real world, this does not hold because the baskets has services like barber, or it is sometimes difficult or even sometimes impossible to arbitrage across two countries. And think of the example of um, hamburger. Can we just buy burger in Japan and take it to the US or in reverse? It is very difficult, or sometimes even impossible in some cases. So um, this prevents from this PPP hold. PPP says that in the long run, this will happen. In the short run, in the real world, it might not exist, but in the long run, it could happen. In the short run, it cannot happen because the goods that are inside the basket, could be difficult to just transfer between the countries. Additionally, the transaction costs exist. It is very costly for people to move stuff between different countries. So, in summary, purchasing power parity says that, if I want to summarize it, purchasing power parity says that we have a buying power being equivalence in different countries. Mm, the same meaning. This is a theory that says in long run exchange rates should adjust. This means that the basket of goods costs the same in both countries when measured in a common currency, say in US dollars. If I measure the same basket in dollars and buy it in the US, that is exactly equal to this basket in Mexico if I measure it again with dollars. That should be exactly equal in both countries. That is what the purchasing power parity says. That's what we call as the law of one price. A good should sell the same for the same price in all locations. Okay? Um, so a unit of any given currency should buy the same amount of goods and services in all currencies. It means that the real exchange rate is equal to one, right? We earlier learned that real exchange rate is equal to nominal exchange rate times price in the domestic country, level of the prices in the foreign country. Now, purchasing power parity says that I can exchange one basket in the US with the one basket in the other country. It means that real exchange rate is equal to one. Now, if I plug in this in the above formula, it is like nominal exchange rate being equal to level of the prices in the foreign country divided by level of the prices in the domestic country. This is basically the same formula. Okay. If the theory of purchasing power parity holds, it means that the price of, for example, Big Mac in the earlier example in both countries should be the same. It shouldn't be 1.16 Big Mac of Japanese Big Mac equal to one Big Mac in the US. It should be exactly equal. One Big Mac in the US, one Big Mac in Japan should be the same. They should be the same when they converted into the same currency, say in dollars. For example, if the price in US dollar, price of the Big Mac in US is $5, and the price of the same Big Mac is, let me just create a blank page. Say, let's talk about the example of Big Mac again. Let's say if the price in US is $5 and the price in Japan is 500 yens, and let's assume that the nominal exchange rate is 100 yen per dollar per US dollar. So let's convert price in Japan to US dollar. If I want to do that, so I just need to plug in the numbers. Okay, 500 yen. Let me write the formula. I just need to convert that. I need to um price of price in yen multiply by nominal exchange rate. This will help me to convert the price into US dollar. It will be 500 yen times 1 USD, 100 yen. This is equal to 5 US dollars. Okay, same as you see what happens? This is exactly the same price as US dollar. This is what purchasing power parity says. So PPP holds in this example. Um, what if, let's say this time, let's say, what if nominal exchange rate is equal to 120 yen per US dollar? What about this one? I would suggest you to pause the video and think about this. Solve the same question and see if you get to the same price. If it doesn't get to the same price, it means that PPP doesn't hold. If you get to the same price, so it means that it holds again. All right, I assume that you paused and you solved it. So it will be 500 yen times 1 US dollar over 120 yen, which is equal to 4.0 4.17 US dollar. So the same Big Mac, which costs 500 yen, is equal to 4.17 US dollar. If I buy this Big Mac in Japan, it is cheaper. I will take it to the US and will sell it at $5 and I can earn some profit. So you see what happens? This is not equal to $5 in the US. So PPP in this example doesn't hold. And the theory says and expect PPP theory expects yen to appreciate, just like this example earlier. Okay, it expects that yen to appreciate over time until it gets closer to $5, until this price will get closer to $5. Okay, instead of just um like this arbitrage can help this happen. Okay, so let's look at another example. All right. So let's say if coffee beans sell for $4 a pound in Seattle and $5 a pound in Boston, and coffee beans can be costlessly transported. In all of these examples, we assume that it's easy and free to just take the Big Mac or coffee from one place, from Japan to the other one. And here again, we are assuming that the coffee beans could be transported just costlessly for free between Seattle and Boston. And the question is asking how will the two markets reach equilibrium? The two markets will reach to the equilibrium by opportunity. Sorry, by arbitrage. Okay, there is an opportunity for arbitrage because it is cheaper in one city and expensive in another city. People can buy it in Seattle, take it to Boston, sell it at higher price, gain some profit, go back to Seattle again, buy at cheaper price. And this is called as arbitrage. Arbitrage means that you buy something at cheaper place, take it to the expensive place, sell it, and gain some profit. Making a quick profit by buying coffee in Seattle and selling it in Boston. Seattle, this will result in an increase in the demand, driving up the prices, and an increase of the supply in Boston, which will drive the prices down, just like this graph over here. Okay, over there we were talking about two countries. Here I'm just talking about two cities. This is what arbitrage means. We buy at the cheaper place, take it to the expensive place, until the two prices become exactly equal. And that is what purchasing power parity says. Purchasing power parity says that those currencies, those values, those conversion rates will be exactly equal in two countries, with the level of the prices will be the ratio of the level of the prices will be equal to the nominal exchange rate. And the currency must have the same purchasing power in all countries. Or in another way to put it, real exchange rate being equal to 1. Okay, a US dollar must buy the same quantity of goods in United States and Japan. One Big Mac here, one Big Mac there, with the same $1. And the Japanese yen must buy the same quantity of goods in Japan and in the United States. A unit of a currency must have the same real value in every country. But what's the use of the purchasing power parity? So we learned that purchasing power parity is a theory which says that prices, which says that the nominal exchange rate and the ratio of the level of the prices in two countries should adjust over the time. And the use of this purchasing power parity is that a theory of exchange rate determination. Another implication is that we can use it to convert other currencies into some common currency that people understand, usually in uh, dollars in the world. Let's look at an example of applying the purchasing power parity. So using the theory of purchasing power parity, find the exchange rate if a bushel of apples sells for $30 in the US and 300 krona in Sweden. So based on the purchasing power parity, the dollar buys the same quantity of goods in the United States as in Sweden. The prices in dollar are equal to the prices in the same prices in krona. So the number of krona per dollar must reflect the prices of goods in the US and Sweden. Real exchange rate is equal to 1, so we will have nominal exchange rate prices in the foreign country divided by prices in the domestic country. So plug in the numbers, the nominal exchange rate will be 10 krona per dollar. 300 krona divided by $30, that will be 10 krona per dollar. Okay? Let's look at another example. So the first application was that we can find the exchange rate, just like what we did here. Using the purchasing power parity, we can find the nominal exchange rate. Another application of purchasing power parity is that we can use it to convert the values into different countries. For example, let's say the average monthly wage in Mexico is 16,000 pesos. An average person in Mexico in each month earns 16,000 pesos. And we know that market exchange rate is 16 pesos per US dollar. When we are talking about market exchange rate, that is the nominal exchange rate. Okay, so market exchange rate, what you hear on the news, what you see on the website, what you see on the Google, all of them are nominal exchange rate, nominal values. We live in the nominal world, and if you want to see the real values, you should convert them yourselves. Okay, and the question is asking how much does the worker get in US dollars? So let's convert the wage using the nominal exchange rate. Just we need to plug in this number in the formula that I earlier showed you, this one. Okay, so we just need to multiply this $16,000 by the ratio of the nominal exchange rate. Okay, so we know that real exchange rate is nominal exchange rate times price of domestic, price of foreign. And we know that here this is equal to 1, and we can just calculate the um, convert the values using purchasing power parity theory by multiplying whatever that we want to exchange, like the wages, to the nominal exchange rate. Okay. So this peso and this peso are going to be canceled out. So we will get that the same $16,000 pesos in Mexico is equivalent to $1,000 US dollar. It means that an average Mexican worker is able to buy goods and services that a worker in the US would be able to buy if they made $1,000. Okay, the $16,000 is equivalent to $1,000. 16,000 pesos is equivalent to $1,000 US dollars purchasing power. So I'm leaving this as practice. In 2025, the average salary in China was 22,053 Chinese yuan per month. Go to xe.com, find the exchange rate. I showed you an example earlier with the Turkish lira, and I think I also showed you euro. We will do more examples with this. Um, Find that exchange rate between US dollar and Chinese yuan and compute how much the salary is in US per dollar. You're gonna do the same type of conversion, multiplying this value into the exchange rate between China and US. Okay, just change these values on the website and multiply it by that rate. Okay, I'm leaving it as a practice for you. Okay, so let me keep this as a practice because the rest of it is more of a review. I mentioned everything. Yeah, I talked about limitations, that it is difficult to just move everything, transport everything. I talked about limitations of purchasing power parity, and I talked about the comparison of nominal and real exchange rate. But let's talk about this last example. There's also one more practice and review question at the end of the slides. But next session on Monday, let's work on this uh, discussion question together. This will help us to review the topic and um, practice and just learn together in the class. Okay? Thank you for bearing with me, and I'm sorry that I had to cancel this class again. All right, see you on Monday.